So this is, I've got the pleasure of taking you through the last two sessions today. The first one is about how to judge financial materiality to determine LEAP priorities. And then the second will be around traceability and data. Yeah, again, we are seeking the middle of the Venn diagram. And of course, that means bringing some financial information to the table. As you saw in the last session, there was a little bit of that already, but that was much more about, say, the nature footprint rather than the financial implications of that and interpreting that in a financial sense. So typically, it's the first two types of tools that Malcolm and Inka walked through that tend to be used for financial materiality screening right now. However, we do see some early form scenario analysis and forward-looking analysis being brought to the table in order to move from this more category-based exercise to a more quantified physical risk assessment. So Malcolm actually mentioned the DMs close the door. Malcolm actually mentioned the DNB study earlier today, so the Dutch Central Bank, and this is generally speaking where the central banks have started. They've started with system-wide assessments utilizing category tools like Encore. So those in essence do something very simplistic around saying that the overall exposure of the Dutch economy is this, or the Malaysian economy is that, or the European area is this. And as a result, they tend to come out with quite large numbers, which attract headlines and which kind of generate momentum in the agenda. But that's sort of the purpose, is to say that, guys, this is super material. Here's a super big number. Did you know that the Dutch economy, because of historical reasons, generates a lot of value add around the agriculture sector, and therefore an extremely large percentage of the Dutch economy is highly dependent or moderately dependent on nature, as an example. This is the same methodology that the infamous World Economic Forum example used. So this is the one where you get the 44 trillion of economic activity is moderately or highly dependent on nature. So either over half of global GDP. I kind of wish that I could say that the methodology was more sophisticated. But again, I think it's fine. I think you have to acknowledge. I think it was 2020 when this came out, actually. So I think at that point in time, it was about utilizing what had just been put out there by Encore, looking at the GVAs of industry and the supply chain gross value adds, and just basically mapping over the dependency scores to that to just to showcase really that there is what in the financial world we would call unhedgeable risk. There is unhedgeable risk here. There is systemic risk. Okay, so and then just to give one example of how one of the central banks did it. So the Dutch central bank, here's a lovely Sankey diagram. So you have all of the types of financial institution on the left, various financial asset classes from loans through shares and bonds, and then all of the business processes under Encore. So that's all of the different ways in which the various loans to the various subsectors depend on these various processes that nature provides. So just to pick out an example. Can't really see it here, but this is what this is in the middle, and then just bucketing that into ecosystem services like soil quality and so on. So they came out with this 500 billion odd number, which was about 30% of all of the portfolios of Dutch financial institutions. A common theme that you'll see in these category assessments, if you do them across a portfolio as a whole, and particularly given that given that these portfolios in essence mirror the real economy of a country or indeed of the globe, is that you end up with water security and hazard regulation really kind of show up as the top exposures. So when I say hazard regulation, that might be something related to regulating the likelihood of a zoonotic event like COVID, or it might be regulating storm surges like storm attenuation and regulating the likelihood of there being a flood. So basically regulating climatic volatility. And then on the water side, access to water. Am I overrunning already? It's okay. Indeed, warning, we are in a difficult situation. So these tend to be the ones that show up. It's a combination of a couple of things. The first reason why they tend to show up is because, I'll flick over to the next slide just to kind of help me explain it. It's because the way in which the value is currently allocated, say on in an index like the MSCI All World Index, is value tends to sit in such a way that the biggest constituents of that index, like technology companies and so on, if you just look at the direct dependencies, well, these companies aren't directly dependent, so they don't really show up. So therefore, you end up on the dependency side noticing like there's a lot of, say, utilities companies or combined with food and beverage, and that's why you have water show up a lot. And then in addition to that, the hazard regulation kind of it covers so many different operational areas of infrastructure sectors that and that could include, of course, mining and the ability to operate your mine or other heavy industry, that kind of tends to show up too. So it's more a function of where value is currently allocated by capital markets than it is a function of this idea that these ecosystem services are valuable or not valuable. At the very beginning of the day, you had Lassour say, sorry if I mispronounce his name, that the ecosystem services are worth X trillion. Blah, 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 blah. That's utilizes a totally different methodological pathway than this one, because indeed the number that's there is many times in excess of global GDP anyway. So in the trillions and trillions, it's like 100 trillion off the top of my head, something like this. So that's why, I mean, this example that I show up on the slide now, which, sorry, I appreciate I hadn't explained, but in essence, this was this is a public-facing exercise that was run by Aon and the University of Cambridge that, in essence, just took, used that same method as you just saw the Dutch Central Bank use, but just applied it to the MSCI All World Index, and then just bucketed those ecosystem services you saw on the far right into just 5 categories, just to make it a bit more manageable, just to give an indication of where the dependencies might lie. And just the last thing to say is that even though this was normalized in various ways that I won't go into here, this score is out of 10, not out of 2.5. So again, it kind of underscores this point of, because the tech companies have such a large and over weighted percentage of these indexes now, it just really doesn't show up. Of course, this is misleading for one final reason, which is that, and this is some of my favorite things to talk about right now with clients, is that you have someone like Taiwan Semiconductor Manufacturing Corporation. I mean, in Taiwan, they decided to prioritize water access for the semiconductor industry over the local agricultural sector when they had a drought recently. There's not a high level of water stress in Taiwan. It just happened to be the situation. But okay, does that show up in it? And you dive into the detail, and you're like, that didn't actually show up for its material for a couple of reasons. One, water stress in Taiwan. We mentioned the water stress tools earlier, and 2, that actually TSMC doesn't really show up in the category assessment tools either. So these little things which, okay, they might seem a little bit disempowering, but at the same time, I think that it's really just about showcasing how when you do these category level assessments, you are missing a lot. which I think is an opportunity in terms of differentiating the strategies when it comes to identifying nature-related risks and opportunities. So the slide I have up now, I think, is a really it's a step change piece of work led out of Oxford and a team of a lady called Nicola Ranger. So this is focused on the UK, and it created 3 forward-looking scenarios, stress scenarios about defensible, evidence-based failures of ecosystem services and the consequences of those. This is where more work is needed, but the evidence base for these stress scenarios needing to be constructed is strong, because if you look at Basel II as an example, the capital requirement, the capital requirements under Basel II need there to account for 1 in 200 type risks. So that's like kind of the probability of risks, and there's a lot of nature-related risks that fall into that category just under that principle. So just to sum up, because the main thing about what was cool about this was that they did create those scenarios in consultation with the experts and the evidence base. So the first one was around the basically just looking at how climatic volatility led to crop failures and an inability of a number of different cropland areas in the UK being able to access water. In essence, there's not enough resilience in those services with the climatic volatility. Between now and 2030, there was one event modelled, and then on top of that, you have the increased insurance premiums that might result in for those sectors if that was modelled in. So then assuming that on top of that, and then in addition to it, modelling all of the labour productivity issues that there might be if people all of a sudden needed to change their behaviour based on where they could feasibly access water if water needed to be distributed. So like just a number of so they were just throwing like a number of different things together to say like all of these things fall into 1 in 200, and like what would be the economic impact of all of these coming together at once. So that was like a domestic scenario that they did. They also did a global scenario, which was very, very similar, but also factored in other likely stress system shocks. So they're looking at pest attacks in Southeast Asia that there's enough evidence about to justify modelling in. So then you've got a number of stable crops like peanuts or rubber or so on disappearing. So what does all of that do? So this was the second one. So that meant that maybe you needed to reallocate land away from biofuels back to staples again. How does that affect? And so I don't need to go into all the detail here, but you see it's like cascade after so it's cascading all over the place. And then the last one they did was antimicrobial resistance, and what that would mean for like any kind of livestock globally. So that plus at some point another zoonotic event from say an avian influenza coming over. And I mean the point here is that they modelled those and what the hit could be to the UK economy, and you're getting around it's a double-digit percentage decline of GDP. So I think that even though these are the first experiments in this area, those little aspects that I just mentioned there and the evidence base behind them is giving people something to engage with and actually starting to see like the specific quantums of impact that are coming through. And I think it's at the edge, but it's the scenario work that you refer to and where we're headed. And I think it's justifiable under capital requirements rules to do this work. Yes, and I mean I've just tried to describe it kind of at like the top levels as far as I could because of time, but also and I think, but just to give you an indication of the components that are going into these things, but it's also why you have
those climate risk teams, say at banks that have been set up, have like the nature risk person being hired, and it'll become an environmental sources of risk question. So this is kind of like where, if you like, physical risk analysis is headed on that triangle. And then just very briefly on the transition risk side, I mean, I suppose where the leading edge has been in the public domain right now is that you could utilize those footprinting methodologies that Malcolm and Inka covered to provide an indication of the quantum of transition risk that the total quantum of transition risk that there could be, that then you might want to apply like specific aspects of the EU nature restoration law to, or whatever it might be. But the basic point is, so this was I think this was the ECB again. In essence, what they did is that they utilized, so we were talking about Globio and Exiobase earlier. So they used the coefficients provided by Globio to quantify the MSA loss for all of the Eurozone economies as a total. So like looking at it like at the proper macro level. But then what they then tried to do, so again, both locally and worldwide via Exiobase, but then what they did, which was more like the follow-on step, which you could argue was the relevant to the ECB, so then assigned that to multiple banks. So in essence, they were able to look at, okay, well, these are the companies with which this footprint is associated. This is the lending to those companies by these banks. They allocated based on the percentage of bank lending, they allocated the MSA score of that company to the bank, and then based on that, got this bottom bullet that you see here. Is that basically the first 10 banks ranked by the size of their impact on nature finance around 40% of the total global impact of the Eurozone economies. So yeah, okay, it's a function of the fact that we have many large banks in the Eurozone. Is quite concentrated right now. But it gives you, I think what I find quite exciting about this is it gives you an indication of, by going through the process that these footprinting tools allow for, you can really understand like what the buckets of exposure are as a financial institution, as a bank, and therefore maybe like what to prioritize and what clients and companies that you finance to prioritize, say, using the WBA nature benchmarking tool with like how are they managing the exposure. So it's really a tool to begin to have those conversations. So yeah, key takeaways, many of the economy-wide assessments, they started using category assessment tools. There are some forward-looking scenario analyses emerging, and you can use the footprinting techniques as an indication of where transition risks may arise within your portfolio. So quick question before I go to section 6 for the room. So thinking a bit more laterally now, maybe, because I think that there's, I don't know, as an outsider, I suppose maybe there's like an obvious answer to this question, but we've spoken about, we had the S group score, 90% of the impact is global, only 10% in Finland. We had this conversation around actually in value, like how much of the nature-related exposure is in the upstream value chain of, say, companies that then operate in Finland, or in the financial portfolios of those of you in the room. I mean, if I was to ask you, like, what percentage of your portfolios are invested in Finnish companies versus global companies, again. So thinking about it from that perspective, where do you actually see the biggest exposures for the Finnish economy?